In 2026, four American companies plan to spend about $725 billion building computers to run artificial intelligence. The revenue to justify that spending doesn't exist yet, not even close. One consultancy, Bain, says the industry needs to find $2 trillion in new annual revenue by 2030 just to pay for what it's building. And even in their optimistic case, they see an $800 billion hole. So here's the real question. Is this the smartest infrastructure bet of the century or the most expensive mistake in corporate history? I'm going to walk you through exactly how the money moves, where it comes from, where it goes, and the three specific things that could turn all of this into the biggest crash since the 2008 global financial crisis. The scale of it all might be too hard to properly hold in your head, so let's start small. Spending. Amazon, Microsoft, Google, and Meta. In 2024, they spent about $226 billion on capital projects. In 2025, that roughly doubled to $410 billion. For 2026, they're guiding to around $725 billion. Amazon alone near $200 billion, Microsoft near $190. Goldman Sachs now expects these four to spend $5.3 trillion between 2025 and 2030. Trillion. And most of those chips come from one company, Nvidia. Last quarter, it reported $57 billion in revenue, up 62% in a year, at a gross margin above 73%. Its CEO, Jensen Huang, put it plainly. Blackwell sales are off the charts, and cloud GPUs are sold out. Nvidia is the shovel seller in a gold rush. And as we all know, when everyone's digging, the person selling shovels always wins. Whether the miners strike gold, that's a whole other story. So follow the money down one more level to the companies actually building the AI. OpenAI booked about $13 billion in revenue in 2025. Real money, growing fast. But it also projects a $14 billion loss for 2026 and doesn't expect to generate positive cash until 2029. And its infrastructure commitments, the deals it signed to buy computing power, reportedly total around $1.4 trillion. Against $13 billion in revenue, sit with that ratio for a second. Now, to be fair, the companies making these bets aren't reckless startups. The hyperscalers are cash-rich, and their cloud revenue is genuinely climbing. Microsoft's AI business hit a $37 billion annual run rate. Google Cloud grew 63% in a quarter. Amazon's cloud grew 28%, its fastest in nearly 4 years. So the demand is real. The problem is timing. The spending is racing years ahead of the income. Morgan Stanley found the hyperscalers made only about $45 billion in AI revenue in 2024, against $200 billion in spending. That gap is what this entire debate is about. And there are three specific ways it could get very dangerous for everyone, not just the AI companies, very quickly. The first, and I am sure many of you have heard of it before, is called circular financing. In September 2025, Nvidia announced it would invest up to $100 billion in OpenAI. And what does OpenAI do with money? It buys Nvidia chips. One research firm estimated that for every $10 billion Nvidia puts into OpenAI, Nvidia sees about $35 billion in chip purchases come back. Nvidia funds OpenAI. OpenAI spends that money on Nvidia chips. Those chip sales become revenue that lifts Nvidia's stock, a loop. Analysts have mapped over $800 billion of these interlocking deals across the industry. AMD gave OpenAI warrants tied to chip purchases. Oracle signed a $300 billion deal. Nvidia put money into xAI's funding round too. The danger is that the same dollar shows up 3 times, as a chipmaker's revenue, a lab's funding, and a cloud's backlog. Impressive until one link breaks. The second risk is less obvious, and it lives in the accounting. It's called depreciation. When a company buys a chip, it spreads the cost over the years it expects that chip to be useful. The hyperscalers assume 5 to 6 years, but Nvidia ships a faster chip roughly every single year. In November 2025, investor Michael Burry, the man who called the 2008 housing crash, did the math. He argued the industry is understating depreciation and overstating profits by about $176 billion between 2026 and 2028. His words, understating depreciation by extending the useful life of assets artificially boosts earnings, one of the more common frauds of the modern era. He compared it to Cisco at the peak of the dot-com bubble. The companies have a defense. They call it the cascade. Old chips move from cutting-edge training down to cheaper everyday tasks and keep earning for years. But even Microsoft's CEO, Satya Nadella, admitted he doesn't want to get stuck with 4 or 5 years of depreciation on one generation. When the buyer echoes the skeptic's worry, you pay attention. The third risk isn't chips at all, it's electricity. So U.S. data center power demand is forecast to more than double, from 31 gigawatts in 2025 to 66 by 2027. And here's the twist Nadella himself revealed. The biggest issue we are now having is not a compute glut, but its power. The richest software company on Earth has chips it cannot switch on because there's not enough electricity to power them all. Where still ordinary people are paying for the scramble. In one major U.S. power market, capacity prices for 2026 jumped to $329 per megawatt. That's over 10 times the level of 2 years earlier. A Bloomberg analysis found areas packed with data centers saw electricity prices rise 267% over 5 years. So the companies are chasing nuclear restarts, on-site gas turbines, small reactors, anything that produces electrons. But transformers take years, and permits take longer. Goldman assumes only half to 60% of new power arrives on time. Now put those 3 risks next to a crisis not more than 3 decades ago, the dot-com telecom boom. In the 1990s, companies spent over $500 billion laying fiber optic cable across the world. Then 85 to 95% of it sat dark, unused, for years, built on a false claim that internet traffic was doubling every 100 days. Fortunes evaporated. So the question becomes very obvious. Are we just laying dark fiber again at 10 times the scale? Not too long ago, we even got a preview of this dilemma. In January 2025, a Chinese lab called DeepSeek released a model it claimed to have trained for just a few $1 million. The market panicked. Nvidia fell 17% in a single day, erasing around $600 billion, the largest one-day loss in history at that point. The fear, if AI suddenly gets cheap, who needs all these chips? But something strange happened next. Cheaper AI didn't kill demand. It made demand explode instead. It's an old economic pattern. Make something cheaper, and people use far more of it. Inference costs are falling roughly 10 times a year, and usage keeps climbing to match. Nvidia didn't collapse. By October 2025, it was worth about $5 trillion. So maybe this isn't 2000 all over again. The spenders have real cash. AI has billions of real users. The chip maker is genuinely enormously profitable. But there's one soft spot that could sink the whole thesis: the customers. An MIT study in 2025 found that despite $30 to $40 billion of company spending on generative AI, 95% of organizations were getting zero measurable return. 95%. The technology works in the demo, then stalls before it ever reaches the profit line. That is the single biggest question mark hanging over the $2 trillion revenue target. So what actually has to happen for this to pay off? Here are the 5 things to watch out for. 1. Does AI revenue keep roughly doubling every year, or does the growth flatten? 2. Do the hyperscalers' cash flows hold steady, or start bleeding as the spending grows unbearable? 3. Does that 95% enterprise failure rate finally invert into real, booked results? 4. Do the power projects hit their timelines or slip year after year? 5. Watch the debt. If lenders start demanding more to hold data center loans, that's possibly an early sign of bad times to come. Because a lot of this is now funded with borrowed money, some of it hidden off the balance sheets. Nvidia raised $30 billion for one data center through a separate entity, keeping the debt off its own books. Across the industry, over $120 billion in data center debt has been pushed out to Wall Street this way. Morgan Stanley estimates a $1.5 trillion financing gap, much of it filled by private credit, the same corner of finance now woven into banks and insurers. That private credit is the channel where trouble in a Texas data center could reach a pension fund you've never heard of. So where does that leave us? Even the optimists are careful. Google's CEO, Sundar Pichai, said flatly that if the bubble bursts, no company is going to be immune, including us. But in the same breath he added, no one doubts the internet was profound. He expects AI to be the same. And that's the best we could really hope for. The demand is probably real, and eventually it might all work out. Dark fiber eventually got lit. It became the backbone of the modern internet, years late, after the first investors were wiped out. So the question was never whether AI matters. It's who's still standing when the revenue finally catches up to the spending. I've been your host, Marcus from Graphne Rubrica. If you enjoyed this video, consider subscribing and clicking the bell icon so the next one doesn't slip past you. Thank you for your time and take care.